Good day, guys. On today's lecture, we'll be covering step 3 and step 4 of IFRS 15, revenue from contracts with customers. In step 3, we'll be determining a transaction price. In step 4, we'll be allocating a transaction price to the performance obligation. Then, there are a few definitions which we need to know in these two steps. The first one has to do with transaction price. Transaction price is an amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amount collected on behalf of third parties. That's the definition for transaction price. The other definition which we need to know, standalone selling price. A standalone selling price is a price at which the entity would sell a promised good or service separately to a customer. Then, in terms of determining the transaction price, our step 3. The consideration promised in a contract may include fixed amount, variable amounts, or both. Then, what we need to know, there are about 5 factors which we need to take into consideration when we determine the transaction price. The first one is about variable consideration. Things such as discounts, rebates, refunds, credits, and etc. And then an entity shall estimate an amount of variable consideration. We can use the expected value to estimate our discounts or rebates, or even the penalties which are most likely that a company will pay. And then the entity shall apply one method consistently throughout the contract when estimating the amount of variable consideration. And then the next thing which we need to take into account when we calculate the transaction price are the constraining estimates of variable consideration. When we do an estimate, whatever the limits or assumptions we are using to calculate our rebates, discounts, and penalties, then we need to take those constraints into account. And then the third thing, which I think is important, is the existence of significant financing component. It means that there might be an interest which needs to be paid, or the interest which we'll be receiving. When determining the transaction price, an entity shall adjust the promised amount of the consideration with the effect of significant financial component, which means the time value of money. For example, if a customer pays upfront in advance, we receive money from the customer, and then we'll render a service after a significant period of time, then it means that whatever the customer has paid, it's more because of time value of money. If we had a promised amount as per the contract, we'll have to add the component of the interest on that price. But if the payment is made late, is delayed or deferred, it means that whatever amount in the contract will need to deduct the interest. It will be the amount in the contract less interest. Then, to calculate the significant financing component, the following factors need to be considered. For example, the customer paid for the goods in advance, and the timing of transferring of those goods and services is at the discretion of the customer. Then, it's not dependent on us whether the component is significant, because it's the customer who's choosing. Number B, a substantial amount of the consideration promised by the customer is variable, and the amount of or the timing of that cost is not substantially within the control of the customer or the entity. Both the customer or the entity cannot determine when they're going to pay or how much they're going to pay. And lastly, the difference between the promised consideration and the cash price of the goods or services arising from reasons other than the provision of finance to either the customer or the entity. Time value of money is not part of or is not a factor in the transaction. Then significant finance component will not be taken into account in calculating the transaction price. Number D, we also need to look at non-cash consideration. Non-cash consideration, it's when we pay in kind instead of paying in money. Lastly, there are other consideration payable to a customer. We have to refund the customer. When you calculate the price, the transaction price, you have to consider that. However, out of the 5, which is the variable consideration, and then the constraint, number B, of estimating variable consideration or significant finance component, which is number 3, number D, non-cash consideration, and number E, consideration payable to a customer. You will be asked to only cover 2. You will be covering the significant finance component and also the variable consideration. Out of the 5, you will be asked 2. In terms of step 4, the allocation of transaction price to a performance obligation, the transaction price needs to be allocated to each performance obligation in accordance with the stand-alone selling prices. I'll assume that in the question you will be given the stand-alone selling prices. Then you need to use them at the contract inception, at the beginning of the contract. And then, if the stand-alone selling price is not directly observable, we are not given the stand-alone selling prices, an entity shall estimate the stand-alone selling prices at an amount that will depict an amount of consideration which the entity expects to be entitled in exchange for transferring the promised goods or services to a customer. The methods which are given to us in the standard to estimate the standalone selling prices, we can have market prices or market assessment approach, which we need to adjust. And also we might be given cost plus margin approach or cost plus approach, or else we might be asked to use a residual approach. And then the last one, it might be a combination of the 3, which is market assessment approach, cost plus a margin approach, or residual approach. Then, this is also important. When we allocate the transaction price to the performance obligations, we need to take discounts, variable consideration, refunds, penalties. We must split the discounts and other variable consideration to all the other obligations. And then, in terms of these steps, there are 2 of them, step 4 and step 3. We have come to an end of this class, and then I'm hoping that you will be able to watch the following one. Then, thank you.